We just heard from the former bond king, Bill Gross, just there. Do you agree with him? Do you see the 10-year yield hitting 5% this year as we see the 30-year, the long bond, very close to 5% right now?
Well, I think the bond market's been following the Fed here. And if you look at Fed projections, the dot plot out to next year, central tendencies are around 5%. If you look at futures and expectations for Fed funds, those are around 5% about a year out as well. So I do think we could head a little bit higher on yields here. I think we're getting closer to a point of stabilization, but there is a bit room to go higher since we have, again, Fed funds still looking above 5% for the foreseeable future.
All right, so a lot of people call Bill Gross the former bond king. We also heard from the current bond king via X last night. This is, of course, Jeffrey Gundlach. He said this in part. I want to read this to you. The U.S. Treasury yield curve is de-inverting very rapidly. It was 108 basis points a few months ago. Now it's at 35 basis points. Should put everyone on recession warning, not just recession watch. If the unemployment rate ticks up just a couple of tenths, it will be recession alert. He finishes off with buckle up. So what about the current bond king? Agree with his assessment?
Well, I think that's an interesting insight as well. I do think these high rates are starting to weigh on economic growth. We're seeing a big slowdown in terms of momentum on the economy. Of course, there are multiple indicators. So the Atlanta Fed numbers are still quite high. The New York Fed numbers are a bit lower. And then you have these powerful recession indicators like the inverted yield curve. And so momentum is slowing down on the economy. I'm not expecting recession anytime soon. The job gains have been quite strong. Historically, you've had 1 to 2 quarters of slowing economic growth before going into recession. The last 2 quarters, of course, have been reasonably strong. So I think the recession may still be a ways out there in the future, but the economy is slowing for sure.
You know, we're doing a lot of bond talk, Robert. I want to ask you one question about equities. According to your research, you're saying that the full-year EPS estimates for the S&P next year are actually going to influence the market in Q4. So you have an estimate of about 8%. I'm looking at FactSet. They're just about 12%. That's growth right there. Give us a sense. How important is the full-year EPS estimate for next year for Q4? And tell us why.
I think it will become very important very soon. So I think we have a convergence of factors here. I do think yields will start to stabilize a bit, perhaps now, perhaps a little bit higher from now. And then when you get into earnings season, we'll start to get a lot of color on what 2024 looks like. And I think it's going to look decent. There's been a lot of work that companies have put in on the basis of this slowing economy to help margins. And so I think even with a slowing economic backdrop, earnings can be quite solid. We're a little bit lower than the street in terms of earnings estimate. I think that's typical. The street overreacts a little bit, gets a little optimistic. But I do think next year can be a decent year for earnings, and I think that will start to matter relatively soon.